Welcome to Market Brief After Hours. It has been a truly fascinating day across global equities, characterized by a serious tug-of-war between geopolitical anxiety and corporate resilience. We are seeing major indices navigate a very complex landscape right now, balancing fears of supply chain disruptions and surging energy costs against some surprisingly strong momentum in the technology and consumer sectors. Let's dive right into the key takeaways from Wall Street. How did the major indices shake out today?
It was a day of sectoral divergence, but overall, the market showed remarkable resilience. Starting with the S&P 500, we saw a 0.25% advance, closing at 6,716. That gain was primarily driven by energy and, interestingly, consumer discretionary. Even with rising fuel costs and regional conflicts dominating the headlines, travel-related stocks held their ground beautifully.
And what about the Dow and the Nasdaq?
The Dow Jones Industrial Average posted more modest gains. It added 0.1% to finish the day at 46,993. It was a bit subdued compared to the others because investors there were heavily weighing the impact of geopolitical rhetoric on global trade and industrial stability. The real standout, however, was the Nasdaq Composite. It climbed 0.47% to end at 22,480. That tech-heavy index really benefited from a robust outlook in the semiconductor space. Optimism surrounding artificial intelligence and some major new corporate partnerships essentially insulated the Nasdaq from the broader market volatility.
Those AI tailwinds just refuse to quit. But hovering over all of this is the situation in the Middle East and its impact on energy. We saw global crude prices surge past the $100 mark today.
That definitely puts pressure on the inflation narrative, especially with the Federal Reserve policy decision looming. Speaking of which, Treasury yields seemed to soften a bit today.
They did. Market participants are clearly adopting a cautious stance ahead of the Fed's announcement. The benchmark 10-year Treasury note slipped to 4.202%, and the 30-year bond yield eased to 4.848%. The 2-year note, which we always watch for monetary policy expectations, stayed relatively flat at 3.674%. It's a delicate balancing act right now. Investors are weighing the inflationary risks of $100 oil against the potential for a geopolitical slowdown. Adding to the Fed's complex calculus is the latest ADP employment data. Private employers only added an average of 9,000 jobs per week in late February. That is a notable drop from the previous period's 14,750. The labor market is cooling, which might give the Fed some pause. Let's cross the Atlantic and look at Europe. Despite the sharp spike in energy costs, which usually hits Europe particularly hard, European markets actually advanced today.
It was quite a resilient showing. The Stoxx 600 climbed 0.6%, really buoyed by strong corporate performances in the UK and Germany. Over in the UK, the FTSE 100 advanced 0.88%. A massive catalyst there was Trustpilot, which surged an incredible 31% following some very optimistic revenue projections.
That is a massive single-day move for Trustpilot. What about the rest of the continent?
In Germany, the DAX rose 0.69%. What makes this fascinating is that it happened even as the ZEW Investor Morale Indicator plummeted to negative 0.5 points, which is its lowest level since early 2025. The current situation indicator also declined to negative 29.9. So you have this glaring divergence. Macroeconomic sentiment is deteriorating, but equity performance remains strong because the market is hyper-focused on individual corporate outlooks. We also saw gains in France, with the CAC 40 up 0.57%, and in Italy, where the FTSE MIB posted a strong 1.19% gain. It was a broad-based regional recovery, though it wasn't without its weak spots. The banking sector faced headwinds, particularly with Close Brothers shedding 3.5% after announcing significant job cuts for a restructuring plan.
It really highlights how investors are picking individual winners rather than trading the broader economic sentiment. We are going to take a quick break, but when we come back, we will dive into the technicals of today's Forex market, look at what gold and silver are doing, and break down the biggest individual market movers of the day. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the major indices and the geopolitical impacts on crude oil. Let's pivot to the foreign exchange market. The currency pairs had a highly technical session today. Starting with the euro against the US dollar, the pair faced persistent headwinds, closing at 1.1538.
The euro is technically compromised right now. Even though it managed a tiny 0.29% recovery from its intraday lows, it is trading significantly beneath its 50, 100, and 200-day simple moving averages. The real damage was the breach of the 200-day moving average at 1.1674. That has solidified a bearish regime. Levels that used to be support are now acting as formidable resistance.
What are the key levels to watch for a USD moving forward?
Immediate downside protection is at 1.1466. If we see a daily close below that, it signals renewed selling pressure and opens the door to much lower targets. For the bulls to regain any control, they need to clear the 1.1600 level first.
Moving to the British pound, GBP USD recorded a slight gain of 0.26% to finish at 1.3354, but it sounds like it's still struggling.
It is. It remains entrenched in a bearish sequence of lower highs. We saw a recovery from a low of 1.3275 today, but the pair completely failed to challenge the 100-day moving average at 1.3397 or the 200-day moving average at 1.3439. That failure to reclaim those key moving averages keeps the medium-term outlook tilted to the downside. Resistance is firm at 1.3385, and if it fails to hold that 1.3275 low, we will likely see a test of the 1.3200 psychological support zone.
The Australian dollar, however, had a better day. AUD-USD rose 0.49% to close at 0.7105. The Aussie dollar outperformed its peers today. It had a decisive bounce from the 0.7049 level and is showing strong bullish momentum. It is trading comfortably above its 50-day simple moving average of 0.6968, maintaining a great trend of higher lows. Buyers are definitely eyeing a retest of the 0.7180 swing high. As long as it sustains its position above 0.7116, a continuation toward 0.7200 looks highly likely. And what about the precious metals? Gold pulled back slightly, down 0.10% to close at $5,002.
Gold experienced a minor retracement after it failed to maintain momentum above the 5,045 level, but make no mistake, the long-term uptrend is incredibly powerful. It is sitting well above its 50-day moving average at $4,953. This just looks like healthy consolidation after February's aggressive rally. Support is at $4,974 and $4,953. A break below that 50-day average could signal a deeper drop toward the 100-day moving average at $4,565.
Silver didn't fare as well. It dropped sharply, down 2.04% to settle at $79.08.
Silver suffered a significant sell-off today. The crucial technical development here is that it broke below its 50-day moving average at $86.62. That large bearish candle reflects a real shift in short-term sentiment. The long-term trend is still technically positive because the price remains above the 100-day moving average at $71.86, but the immediate momentum is decisively negative. If it fails to hold above $78.28, we could see declines towards $75 and potentially down to that 100-day moving average.
Moving away from the commodities and currencies, let's get into the individual market movers today. There were some massive swings in single stocks. Lemonade Inc. had an incredible day.
Lemonade was a massive standout. Shares surged more than 16%. This was entirely driven by Wall Street analysts. Morgan Stanley upgraded the stock to overweight and slapped a new price target of $85 on it. When a major institutional player issues an upgrade like that, it tends to force a lot of capital off the sidelines.
We also mentioned earlier how the AI and tech narrative was boosting the Nasdaq. Uber and Lyft were right in the middle of that today.
They certainly were. Uber Technologies rose over 4%, and Lyft added more than 3%. The catalyst here was news of separate autonomous vehicle development deals with NVIDIA. NVIDIA's optimistic revenue forecasts have been lifting the entire semiconductor and AI space, and now that momentum is bleeding into the ride-hailing sector. The prospect of autonomous fleets becoming a reality sooner rather than later is highly attractive to growth investors.
Not all the news was positive, though. Eli Lilly took quite a hit.
And finally, on the downside, Semtech had a brutal session.
Semtech tumbled more than 11%. It all came down to forward guidance. They provided a first-quarter earnings forecast that fell short of analyst expectations, landing at the very lower end of their projected range. In a market that is pricing in perfection for tech and semiconductor-adjacent companies, any hint of weakness in earnings guidance gets punished severely.
It really is a market of stock pickers right now. As we wrap up today's session, the entire global financial community is shifting its focus toward the Federal Reserve's impending policy decision. The escalation of the Iran conflict and the surge in oil prices have introduced fresh inflationary risks. Yet, the market clearly remains hopeful for a diplomatic resolution. The resilience of the technology and travel sectors shows that corporate fundamentals are still providing a buffer against this macroeconomic uncertainty. It will be fascinating to see how the Fed addresses these geopolitical headwinds. If you find this useful, please follow Market Brief after hours. Thank you for listening, and we will see you for the next update.